This is what it is the broken COMEX gearbox. There's so much evidence that the COMEX is in the rearview mirror. And while lifeblood liquidity drains out of the West, there's only one viable non-default option, and that's to allow the silver price to rise to meet a physically settled supply-demand price set by institutionals in the global-facing, high-quality liquid asset collateralized free trade zone SGE exchange. Gold at 6,500, just a similar scope structurally, and silver at 155, right now consolidating smack in the middle of the mid-bullion bank ranges for silver and gold.
Andrew Maguire asserts that the silver market no longer behaves like a normal paper-driven market. He states unequivocally that the COMEX pricing structure is losing control as physical demand, Shanghai premiums, and tightening supply expose a deeper shortage beneath the surface. He maintains that silver's multi-year deficit is not temporary. Supply will not expand quickly enough, fabrication demand is being replaced by investment demand, and inventories are being drained at an increasingly unsafe margin. This creates a market intensely vulnerable to volatility and sharp upside repricing. Maguire points to major price projections already under discussion, including silver targets around $135, an extreme bull case near $309, and his own structural outlook for silver moving toward $155, while gold advances toward $6,500. His message is clear. Paper sell-offs may create short-term fear, but the physical market is forcing a much larger revaluation. Now, we present the clips from Andrew Maguire's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Looking at silver, the latest World Silver Survey underscores massive supply shortages and higher global prices. Now, quote, "The silver market is entering a phase where traditional balancing mechanisms are weakening, supply cannot expand quickly enough, fabrication demand can fall, but is being replaced by investment demand. Inventories continue to absorb the difference, but at a declining margin of safety. This creates a system that is increasingly prone to volatility and upside repricing. The implication is straightforward." This is their quote. "The multi-year deficit is not an anomaly. It is the defining feature of the current cycle. Its resolution will not come through normalization. It'll come through price. And based on the trajectory outlined in the data, that process has already begun." Now, the bullion banks, long gold for their own books, are also long silver. There are a range of estimations. They're all above the current levels. The most notable coming from the Bank of America, assessing a base case for $135 per ounce to their extreme bull case of $309 per ounce. Bank of America targets are derived from the expectation of a higher gold price alongside a gold to silver ratio compression. Now, while Fed agent bank JP Morgan is the laggard, and they're just suggesting $81 silver, for all the reasons that we've just given, liquidity providers assess JP Morgan is actually extremely long silver for their own book and are not selling a single ounce. Obviously, they are an official agent for the Fed. They operate in the treasury markets, they operate in the gold and silver markets. And as we've recently outlined, while underpriced COMEX silver is locked in for delivery due to export controls, first notice warrants being demanded for delivery command premiums that mirror a 13% over 13% SGE physically settled spot price. This is plus VAT. And this means that cash settlements are based on an agreed related bilaterally settled LBMA physical delivery price, and it's currently annualized conservatively at plus or minus 8%. Then you've got the sundry shipping costs. While these arbitrage margins are thin, silver is in such short supply that it's being drained into PBOC coffers. Now, given global US export controls have now been implemented, Imports into London are being completely bypassed, forcing very large legacy market leasing costs, but these leveraged borrowings are then sold into the market and ultimately end up flowing into the SGE physical hubs, forcing these borrowed and sold derivative benchmarks to be paid back at sequentially higher and higher prices. This is the doom loop that we referred to last time, and we've identified that this is what it is the broken COMEX gearbox. There's so much evidence that the COMEX is in the rearview mirror. And while lifeblood liquidity drains out of the West, there's only one viable non-default option, and that's to allow the silver price to rise to meet a physically settled supply-demand price set by institutionals in the global-facing, high-quality liquid asset collateralized free trade zone SGE exchange. So in summary, with long specs cleaned out and momentum shorts still embedded against commercials on the long side, the setup is structurally as bullish as it was ahead of the commencement, the $75 October 24 rally into the highs from $45 into 121, and the $1,700 rally in gold from 38.50 to 5,600. Structurally and short term, this portends gold at 6,500, just a similar scope structurally, and silver at 155. Right now, consolidating smack in the middle of the mid-bullion bank ranges for silver and gold. Obviously, the war-induced volatility is very short-term, giving the edge to the naked short momentums. But all of these synthetically sold naked short positions will have to be bought back. And with no long speculators on board, the coiling, physically driven rally is so underpriced that it will surpass all the previous January and February all-time highs.
Andrew Maguire insists that the current weakness in gold and silver is not evidence of structural failure, but rather the intentional result of a paper market setup designed to lure in momentum shorts. He declares that large flash selling events in illiquid conditions deliberately create bearish charts, particularly around key reporting periods. But beneath that pressure, the physical market delivers a starkly different message. Shanghai premiums remain robust, silver trades with unmistakable signs of backwardation, and physical buyers are consistently absorbing supply even during orchestrated sell-offs. Maguire contends this demonstrates that paper pricing is rapidly diminishing in relevance as real metal moves to stronger handses. He underscores that large commercial players are now positioned long, not short, while speculative longs have already been purged. This creates a tightly coiled setup, where short positions will eventually be forced to cover at significantly higher prices. Let's get back to the interview.
Now, as you can probably see here, not because they reveal any useful microdata, but because when connected the dots from the open interest highs of 800,000 contracts in 2020 into a cliff fall exit of this open interest into current 367,000 contract levels, that's a one-way exit of 1,400 tons of physical and 100% one leverage gold, which actually really is more like 140,000 tons of dilutive paper leverage. That's never going to return. Now, in silver, we see an exit of 18,500 tons, which, as CPM stated some while ago, they said, 500 to 1 for silver, so what? Well, at 500 to 1, that actually evidences an exit of 9.3 thousand tons. Yes, that number, 3,000 tons of dilutive open interest, seeking actually a safe haven refuge. People are one out of this mayhem, which is, we're going to see really how it's generated. Now, these smoke and mirrors COT reports do provide us a window into the degree that the LBMA CME price settling benchmarks are becoming irrelevant. And with the LBMA dependent on being able to cash settle foreign exchange gold and silver into its collusive COMEX partnership, we're witnessing the LBMA's last gasp as a global price setting hub. So let's dig in. Long-term subscribers will know why we mistrust this deliberately delayed official weekly reported COT data. We're going to look at it in a second. And why we cannot take it at face value. Therefore, in order to make sense of these reports, it requires us to, as best as possible, weigh in the one-sided COMEX data against the deliberately unreported offsetting LBMA over-the-counter data. Now, given both sides of these transactions are held by the same commercial market makers, but the invisible reported offsetting over-the-counter leg of the report that's published is just accepted at face value by the self-regulated CME. This can and has historically proved to enable some very bad actors to directionally employ an otherwise illegal hidden position concentration level and for it to exist. Now, if a single entity or a potential cabal of traders with a common goal own a large enough percentage concentration of issued leveraged COMEX open interest, the chips in the casino, and of course these are all cash-settled futures positions, then they ultimately control the direction of that asset's price. Clearly. And this was a major concern that Commissioner Bart Chilton, he is CFTC Commissioner, publicly drew attention to during his tenure at the CFTC, specifically drawing attention to such concentration being utilized to directionally manipulate silver lower after JP Morgan took over the untenable Bear Stearns short silver position in 2008. And it was actually the Bear Stearns silver position that imploded that bank. Now, all of this data is extremely well documented. Now, I'm recording this episode on Wednesday for release tomorrow, and you can see we're trying to get these things out as quick as possible. And as a recent example, let's look at yesterday's COMEX-driven footprints. Now, drilling down into yesterday's full session, end of ceasefire bearish skew, all session long it had been bearish right from the opening through the AM and then the PM fix. Right on cue, we evidenced a perfect example of a bad actor employing a directional position concentration ahead of the COT cutoff, which was down here. Undoubtedly, this was officially sanctioned as it was just too obvious. But let's just pick up this one bar here. Basically, this is what we're picking up on. To illustrate that the tweet-driven action is 100% COMEX-driven, the timing of 23,000 contracts, 106 tons of gold futures open interest was flash dumped directly after the fix and clearly designed to get the worst price. And essentially what they were doing was chart painting a bearish skew and undoubtedly related to Friday's yet to be published COT cutoff, which won't be published until Friday. And then we'll see what the action entailed. But this flash discount did not go unnoticed. This is ludicrous to see this kind of volume of being actually sold into in a flash sale to get the worst price. In the most illiquid, waiting till the fix was done and it was illiquid. As I say, it didn't go unnoticed, simultaneously evidencing very strong Shanghai spot gold physical premiums into this sell-off. And looking at the 4-hour charts, we can better see in a less granular form the commercials exposed to upcoming T+1 physical market delivery obligations. We're hedging this exposure into the 4683.20, the 38250. This is the retracement fiber. Everyone looks at this. Now, undoubtedly taking the long side of a rapidly dwindling number of freshly sucked in momentum shorts, which is exactly what happened as soon as we see a sell-off. And par for the course, what do you see happening again today? Wait for the PM fix and then literally start selling into illiquid conditions. Now, clearly, this is paper versus physical, and the physical market is simply taking it. Similarly, silver evidenced a concurrent flash sold, literally here, 1,000 tons of paper market, literally 1,000 tons, also seeking to chart paint the commercial cutoff, which they did by the time it got down to here. And then, of course, the momentums continue to try and sell it. So essentially, it was designed to draw in these sellers, which will provide the commercials fuel to short cover into. And while this was going on, while this selling was going on, essentially what we saw was concurrently an unwavering $10.58 Shanghai premium plus VAT. And we're talking about $10.58 in silver here, where underpriced versus underpriced. This is the May contract, the May silver contract. And it's going to be targeted for COMEX delivery at May contract expiry next Wednesday. Now, given US export controls, it will once again result in forcing large cash settlement premiums in London. Now, notably, after all this drama, spot silver is trading at a premium to the May futures contract. It shouldn't be. That means it's backwardated. It's been averaging 6 cents, but it was actually backwardated to as much as 11 cents into dips. And that Shanghai spot continues to evidence a continuous, consistent today, $10.57 premium to local London spot. You can see the disparity. The physical price right now is 88.70, all the way up into around about this level here.
Andrew Maguire warns that gold and silver markets are entering a phase in which physical reality will overpower the paper pricing system. He declares that COMEX and LBMA benchmarks are rapidly losing their authority as more liquidity leaves the West and physical metal flows to Shanghai-linked markets. Sets. The critical point is that silver is no longer responding to ordinary trading pressure. Instead, it is being inexorably driven by a profound supply-demand imbalance, rising physical premiums, and irrefutable evidence that available inventories are far tighter than the paper market reveals. In Maguire's view, the only viable solution is for silver to rise toward a price that truly clears the physical market. This is why his forecast is extremely bold. He is certain that gold is structurally moving toward $6,500 and silver to $155, while other credible estimates range from $81 to $135, and an extreme bull case reaches $309. Share your thoughts on Andrew Maguire's analysis in the comments. If you find this video helpful, please support the channel and turn on notifications for more updates.